concept and the presentation that we coin the family bank. And in reality, this is not my idea. The concept has been going on for quite some time. In fact, in 1950, when whole life insurance policies were really becoming the rave back then, the concept was born by a gentleman named R. Nelson Nash, and he wrote a book called Become Your Own Banker. And I don't know if you've ever heard of that, but the ideas and the concepts that we are using right now are very time-tested, they're very proven, but of course we're using the modern life insurance products and the modern life insurance ideas. So the idea of the family bank is really going through and understanding how the banking system works. And if we kind of look at what does a bank do, you know, banks are just like other businesses. Their product coincidentally happens to be money. That's what they're selling. Where other businesses sell widgets or services, banks sell money, and they do it in the forms of loans, they do it in the forms of certificates of deposits, and of course other financial products that they sell. But really the money that they make is on the interest that they charge on those loans or those other products. But the funny thing is, it actually comes from our own deposits. And we are called the depositors, as you know. So what we do is the depositors put money into this. We expect a certain rate of return. The bank takes our money, turns around, and reinvests that, getting a higher rate of return, and sometimes even back to us in the form of car loans, house loans, credit cards, you know, whatever the case may be. So each and every time that we receive a paycheck or money, typically we receive that in the form of a paycheck or some type of check that we go to the bank, we deposit that. The bank says, okay, for opening up the account, we're going to go ahead and pay you a nominal rate of return. I've got here a figure of less than 3%, but the reality is the national rate of return that the typical checking account earns is 0 to 0.9%. In fact, that 0.9% is closer to the average savings account. And then if we need to borrow money in the form of a car loan, a house loan, a credit card, you know, whatever the case may be, the bank uses our own money through this filter system, but they charge us a much higher rate of return, 7%, 24%. So I've actually been working in this industry now for about close to 20 years, but exclusively the last 12 to 15 years, I've really been working with a lot of business owners and teaching them that although that they are in the business of whatever they do, they are really in the banking business too, but they just don't know it. And the reason why they're in the banking business is they're losing money. And they're losing money because this interest rate that the bank normally earns and wins, they are really forfeiting that to the banking industry and then getting little to nothing. In fact, they're paying out rather than earning. But the same really holds true for the average person, even if they don't own their own bank or own their own business. Each and every time that we have an account and we let another investor, like a bank or a broker, hold that money, they obviously are earning a higher rate of return and only giving us a small portion. So the idea and the concept is, how do we change this? And it really comes from understanding this concept here. It's called the Rule of 72. Now, the Rule of 72 is a mathematical formula. It was developed by Albert Einstein, and he called this the ninth wonder of the world. You and I know this as compounding interest. And the Rule of 72 says whatever rate of return you earn on your money, divide that into 72, and that tells us how many years it takes for our money to double. So if we look at an example, if we just take a 30-year-old who has $1,000 and he takes that $1,000 and goes to the bank, and the bank says, okay, for opening up the account, we're going to give you 3%. We then take 3, divide it into 72, and that tells us that every 24 years our money will double. So when we're 54 years old, our account doubled to $2,000. Another 24 years goes by, we got $4,000. But when we open up that bank account, we know that the bank doesn't put our $1,000 in a white envelope, seal it, write our name on it, and then just go stuff it in the safe. We know that the bank takes that money and they turn around and invest it. And we know that it's very easy for a bank to turn around and get, an 8, 9, 10, 11, 12, 13, 14% rate of return on their money. So what they're doing is they're using our money to make money, but they only pay us this pitiful rate of return. And let's just say in this example that they take our money, get a 12% rate of return. Well, 12 into 72 is 6, so the money will double every 6 years. Now this column here is the bank's column. This is what we get out of it. So if we then go to look at age 54, our money has doubled from 1 to 2 to 4 to 8 to 16. So we now have $16,000 that the bank has leveraged, but they only really owe us 2. Another 24 years goes by, we have 1, 2, 3, 4 more doubles. That money is now grown to be worth $256,000. And of course, if we cashed out our account at that point, the bank just gives us $4,000, but they made a tremendous amount of money. So you see, anybody that has ever had or currently has or will have a bank account, they are in the banking business. And they are in the banking industry, but they are allowing the institution to make all the profit. And there's a very simple way for us to turn the tables. So let's kind of look at a typical example. Let's say that we buy an asset like a car for $40,000. Well, most of us don't have $40,000 in cash laying around. So what we do is we go to the bank, we negotiate a rate of return and a time frame. So this is a 5-year note, which is the average length for a car. We get a 7% interest charged on this, and they come up with a payment. So let's say that we have a payment of $792. For 60 months, we will pay a total of $40,000 or $47,522. But we buy an asset that depreciates in value. And in fact, after 5 years, this $40,000 car may only be worth 15 grand. So the question really is what rate of return are we earning on this entire deal? Are we earning some money because we get 15 grand if we sell the car then, but we paid $47,000? Well, the answer is we get a 0% rate of return. In fact, we actually lose money in this deal too, so we could actually say that we have a negative return. Now, of course, we drove the car for 5 years and we're happy to go from here to there, but the reality is when we look at the pragmatics of the dollar bills that go out, funnel through our bank account, back to the bank in a profit, we have a 0% rate of return. Now, if we use Albert Einstein's mathematical formula, 0 into 72 is 0. So we're never going to get ahead this way, which is obviously one of the reasons why we always try to get all of our clients, whether they own a business or not, to try to be as debt-free as soon as possible. But there are other issues, and to understand the concept even a little bit further, we buy a house for $500,000. Now, this may be more than the average person out there, but we just want to play with the numbers because it's the mathematics and the concept we want to understand. Let's say that we get 7% rate of return for a 30-year mortgage. Well, we make a monthly payment that is comprised of principal and interest. If we make each and every payment on time over 30 years, we'll pay more than twice for this home than our original loan. We end up paying nearly $1.2 million. And again, if we were to ask what rate of return are you earning on the deal, the answer is still 0. But it is really worse than this, because this is an asset now that if we then turn around and sell, this one has the likelihood, unlike our cars, to appreciate. Well, if we want to turn around and sell this house, and let's say that it has grown to be worth $1 million. Now that's pretty good, doubling the cost of the home, but now what happens is we still paid $1.2 million. We can sell the house for $1 million, but now we have to pay taxes on an asset that still is worth less than what we put into it. Now the IRS allows us to have up to $250,000 if we were to sell this house to buy another house. So if we sold this house for $1 million, even though we paid $1.2 million for it, we'd still have to pay taxes on $250,000. So there always seems to be a catch here when we really don't understand how the banking system works and how tax